What if I told you that with just $50 a week, you could build a monthly income of $10,000? Sounds too good to be true, right? Well, it's possible, and all about the power of consistent investment and intelligent financial strategies. You can gradually build a significant income stream by setting aside a small amount each week and leveraging tools like dividend reinvestment plans. So, curious about how this works and eager to unlock the secrets to financial freedom? Well, let's get started. First, you need to understand that the secret to making lots of money isn't a sudden windfall or a get-rich-quick scheme. It's all about the powerful principle of consistent investment. Think of a bucket with a small leak. If you keep adding water steadily, even if it trickles, it will eventually overflow. Consistent investment works the same way. Regularly putting aside a set amount, you harness the power of compound interest. This means your money grows from its initial value and earns interest on the interest accumulated. Over time, even small investments can increase significantly. Let's consider an example. Suppose you set aside just $50 a week. That's a manageable amount. Maybe the cost of a few coffees or a minor adjustment in your spending. Over a week, it's $50. In a month, it adds up to $200. By the end of the year, it totals $2,400. This seemingly small amount is like planting a seed for your financial future. The key is not about the amount itself, but the consistency. By diligently setting aside $50 weekly, you create a habit of saving and investing. This regular behavior establishes a solid foundation for building long-term wealth. And this is just the beginning. We have emphasized the value of consistent investment. Now, let's delve into a powerful tool that can significantly enhance your $50 weekly contributions: dividend reinvestment plans. The best illustration for this is owning a share of a thriving company that regularly shares its profits with you through dividends. A DRIP allows you to automatically reinvest these dividends to purchase more shares of the same company. It's like having your money work overtime for you. But how do DRIP boost your financial growth? Mainly through compound interest, which is put on autopilot with DRIP. As you reinvest dividends to buy more shares, these new shares generate dividends. This creates a snowball effect, rapidly increasing your wealth over time. DRIP also helps you navigate the unpredictable stock market through dollar cost averaging. By investing a fixed amount consistently, you buy more shares when prices are low and fewer when prices are high. This method helps you acquire shares at a lower average cost over time. DRIP automates reinvesting dividends, saving you the hassle of manual reinvesting and ensuring you take advantage of every opportunity to grow your investment. Now, let's consider a real-world example. Suppose Company X pays a quarterly dividend of $1 per share, and you own 10 shares. Instead of taking $10 in cash, you reinvest it through DRIP. The $10 buys a fraction of another share, since share prices are often not whole numbers. Now you own 10.1 shares. Next quarter, you will receive a slightly higher dividend because your share count has increased. This cycle continues, gradually increasing your holdings and the dividends you receive. But you shouldn't stop there. Consistent investment, even in small amounts, is crucial for growth. Remember the overflowing bucket analogy from earlier? Like a steady stream of water, regular investments will eventually fill the bucket. DRIP takes this further by automatically reinvesting your dividends, creating a self-perpetuating growth cycle. Skipping contributions, however, disrupts this cycle and slows down your progress. Even small leaks in the bucket can delay its overflow. And similarly, missing a $50 contribution might seem minor, but over time, it can noticeably affect your long-term returns. But again, while sticking to $50 contributions is a great start, increasing them whenever possible can work wonders. You know why? Well, compound interest grows your returns not just on the initial investment, but also on the accumulated gains. Increasing your weekly contributions creates a more extensive base for compounding, enhancing the snowball effect. By contributing more, you buy more shares from the beginning, which means a larger pool of shares generating dividends and faster growth towards your financial goals. To make this work, consider a few strategies for increasing your contributions. Review your budget and identify areas where you can cut back on unnecessary expenses. Even small increases in your weekly contributions can significantly impact over time. If you receive a raise or a bonus, allocate a portion to boost your weekly investment. Think long-term and focus on the future benefits. You set yourself up for a more financially secure future by sacrificing a bit now. But for you to be more successful, you need to choose the right stocks to fuel your DRIP engine. First, we have blue chip dividend stocks. These big, well-established companies are known for their financial stability and regular dividend payouts. Think Coca-Cola or Johnson & Johnson. Blue chip stocks are great for DRIP because they offer reliable dividends, lower volatility, and the security of investing in industry giants. However, their growth potential might be slower than smaller companies, and their dividend yields might be lower than those of high-yield dividend stocks. Next, we have dividend aristocrats. These top-tier blue-chip companies have increased their dividend payouts for at least 25 consecutive years. They combine the reality of blue-chip stocks with the added benefit of a growing dividend stream, enhancing the compounding effects with your DRIP strategy. However, like blue-chip stocks, they might offer lower dividend yields and have higher share prices, meaning it could take longer to accumulate a significant number of shares. Then there are high-yield dividend stocks offering attractive dividend yields, often exceeding 5%. These can be particularly enticing for income-focused investors because of the potentially higher income stream they provide. However, these stocks come with risks, such as financial instability, which could lead to dividend cuts, and higher volatility, which could affect both the share price and dividend consistency. Number 4, we have growth-oriented dividend stocks. These companies balance regular dividend payouts with potential share price growth, appealing to investors looking for income and capital appreciation. They tend to increase their dividends over time and offer growth potential that can accelerate wealth creation. However, they might be more volatile and carry higher risks compared to blue chip stocks, and their starting yield might be lower than those of pure high-yield stocks, though they have the potential to grow. So how do you choose the right stocks for your DRIP strategy? Well, it depends on your risk tolerance and investment goals. Blue chip or dividend aristocrat stocks might be ideal if you're an income-focused investor with a lower risk tolerance. If you're seeking higher income and have a moderate risk tolerance, high-yield dividend stocks could be an option. But do your research carefully. Growth-oriented dividend stocks might be a good fit for growth and income with a higher risk tolerance. But remember, DRIP is a long-term strategy. Diversification is vital, so consider incorporating a mix of these categories into your portfolio to manage risk and optimize your returns. By carefully selecting the right stocks and consistently contributing to your DRIP, you can create a powerful engine for long-term financial growth. Now, let's do the projections. Let's start by assuming that you consistently invest $50 per week, which adds up to $2,600 annually. Let's take an average annual return of 10%, which is a conservative estimate considering historical stock market averages have often been higher. Also, we'll reinvest all dividends through DRIP. Let's see how your investment could grow over time. After 10 years, your $26,000 investment, 10 years times $2,600, could grow to around $89,500 with consistent contributions and a 10% annual return. An average dividend yield of 3% could translate to approximately $2,685 in monthly dividends. In 20 years, your $52,000 investment could grow to about $322,000. A 3% dividend yield could generate an estimated $9,660 in monthly dividends. After 30 years, the magic of compounding truly shines. Your $78,000 investment could snowball to over $1.17 million. A 3% dividend yield on this amount could translate to a staggering $35,100 in monthly dividends, surpassing the $10,000 monthly goal. However, there are important considerations to keep in mind. The stock market experiences fluctuations, so your actual returns may vary. Moreover, dividends and capital gains may be subject to taxes, so consulting a tax professional is wise. However, the longer your investment horizon, the more significant the compounding impact will be. Reaching the $10,000 per month target in 30 years requires long-term commitment, but there are ways to accelerate your progress potentially. Consider increasing your weekly or monthly contributions whenever possible. Exploring higher yield stocks can offer a faster path to your income goal, though they come with more risk and require thorough research. Also, reinvesting windfalls like bonuses or tax refunds into your investments can help boost your growth. These projections highlight the power of consistent, long-term investing. So, what are the tips to reach these levels of financial goals? First, embrace consistency and patience. Building wealth through DRIP is more of a marathon than a sprint. The key is to keep making those regular contributions, even if they initially seem small. Patience is equally important. Don't let short-term market fluctuations discourage you. Trust in the power of compounding to do its work over time. Next, make sure to review and adjust your portfolio regularly. The investment landscape is consistently changing, so checking in on your portfolio once or twice a year is a good idea. Look at how your chosen companies are performing. Have there been any significant changes in their financial health or business strategy? Also, consider the broader market conditions. Have there been significant economic shifts that require you to tweak your portfolio? And importantly, think about your financial goals. Are they changing? You should adjust your asset allocation or risk tolerance to stay on track. During these reviews, you may rebalance your portfolio if one type of asset has outperformed the others. This helps maintain your desired risk profile. Consider selling any underperforming stocks and reinvesting in more promising options. Start small and grow gradually. One of the great things about DRIP is that you can begin with a manageable amount. There's no need to invest a large sum right away. Start with what you can comfortably afford, even if it's just $50 a week. As your income grows and your budget allows, increase your contributions. Every extra dollar helps build your future financial security. You can also automate your contributions by setting up automatic transfers from your checking account to your investment account. This ensures you never miss a contribution and removes the temptation to skip them. Make sure to also educate yourself about the financial markets and investment strategies. The more you know, the better decisions you can make. And don't hesitate to seek professional guidance. A financial advisor can provide personalized advice tailored to your situation and risk tolerance. And that's it. So, are you ready to start building your financial future one small step at a time? Start with $50 a week and watch your wealth grow. What are you waiting for? In the meantime, leave a like, subscribe, and make sure to turn on the notification bell for more amazing videos like this one.